Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn from Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we put out on the internet. Go to focuscompounding.com. If you're watching us on YouTube right now, this is our website, and you can get access to write-ups on investing going all the way back to December 2005 from Geoff Gannon for free at focuscompounding.com. If you want to learn more about our money management services, you can reach out to me at andrew@focuscompounding.com. If you're going to be in Omaha for the Berkshire Hathaway shareholder meeting, reach out to me if you are a prospective investor and would be interested in learning about our fund or the managed accounts from the perspective of making a investment. We are going to be there May 3rd through the 7th in Omaha. And you could reach out to me at andrew@focuscompounding.com. We'd love to sit down, have some coffee, chat, get to know each other, and talk about everything that we are doing on the money management side of things. So, Geoff, today that we are recording this is February 22nd, which means tomorrow is February 23rd. Do you know what took place, what started 5 years ago on February 23rd?
No.
That is the fifth year. That is going to be our 5-year anniversary of the podcast. We started February 23rd, the Focus Compounding podcast, and I was listening to it today. And it was funny, like we used to have the intro, this is the Focus Compounding podcast where we take questions asked of us and blah, blah, blah. And we really use it as a way to field questions from individuals and really to market the website, Focus Compounding. Mm-hmm. We had a subscription model back then. Now everything is free, but we are coming up on 5 years. Tomorrow is our 5-year anniversary on the podcast. So I want to say congratulations to you. Thank God we made it. Didn't know that we would, but here we are. And thank you to everybody for listening. Pretty crazy. 5 years on the podcast. How did we even come to start the podcast, Geoff? I mean, take us through it from your perspective.
Well, I wanted to do a podcast. I suggested that we should do a podcast, and you suggested didn't want to do it. What was the point of it, or what were we going to do? I don't remember all the details of what the issue was, but yeah, and of course the early ones we had to record in batches of a bunch of them because they were shorter, and we had less time to do that. We recorded in a different place and all that.
In a little corner. Remember that? Little corner in the office, little black desk. We recorded. I think we actually, so this is so funny. I mean, the lights were like fluorescent lights above, and they were super loud. So I remember the mics would pick up on it. So didn't we have to shut the lights off sometimes? And we had like a little lamp that would be there because it wasn't as loud.
Yeah, I think we had some cleaning people come in sometimes, and we had some other issues. Yeah. We recorded in a bunch of different places over the years.
Yeah. That was a grind.
Because that isn't even where people saw the first videos. That's also an office, but not the same office. Yeah.
Mm-hmm. I would go and you would come to where I was working, my office, and we would record. And a lot of times we would record after market hours, right? Or after office hours. I mean, be like, 5, 6 o'clock. I mean, honestly, for like the first, 50 podcasts until I went full time with Focus Compounding, I'd just be like delusionally tired. I'd been working all day and then trying to pump out 3 podcasts because we would batch record at, whatever it was, 5, 6, 7 o'clock at night. And I just remember it being a grind, especially when we were doing like hour-long podcasts. We've gone through different I guess you could say like different phases. Sometimes, we would do shorter podcasts and then we do longer podcasts and we did shorter podcasts. And now we're back to the longest that we have done, which is shooting for, around 2 hours. Why has that changed so much over the years, would you say?
Well, one, the kinds of things that we've covered have changed a little bit, and then also whether recording in person or not, I think also is an effect on it. So it's probably easier to record a batch of them on specific topics that could be 30 minutes each or something if we're together recording them and we have a bunch of topics that don't matter when in time we put them on, right? But as we incorporated more timely stuff into it, then it became more of an issue that we couldn't really record things far in advance. And we started incorporating more stuff with whether it was Twitter or other things, and doing less of the specific topics. Although the specific topics, we probably get more views on YouTube or something, even if they're just audio or whatever, because they're shorter and on one specific topic. Whereas this is more set up for, like a lot of podcasts are, like it's a weekly thing and it covers a bunch of different topics, not just one. So it's a little bit closer to what most people do, I guess.
Which do you prefer?
I'm not sure. I think this is fine, that this could work fine if we, depending on how we organize it. But yeah, I like the specific topics too. And some of, probably my favorite ones were individual topics that we did. But the offset to that is it's good to use specific topics with something current. And if we did things that are, like, some of the early podcasts you're talking about one topic that we did, we basically try to aim for like 25 minutes. So it's not a lot of room for talking about examples of current things, pointing to it and using quick FS and all that kind of stuff that we can do now. So that's good. My preference would be to use the general topics that are useful all the time, but to use current examples for that, right? So if you do a podcast about netnets, you want to talk about netnets that exist today. If you do a podcast about whatever, you want to use examples from today. Otherwise, it's more like a lot of YouTube things that I see, right? That kind of they're shorter, although they're pretty long compared to what YouTube videos were not that long ago, but they're shorter than the long form podcast we do now. And they're shorter, probably even a little bit shorter than the short episodes we did before. But what they don't do is any examples of current things, right? They're like more highly produced, and they'll just tell you about what Ben Graham or Warren Buffett did in the past or whatever. And there's no exploring what that means here with some tickers and things that might be interesting to people now that they can look at and understand, and suggest some stocks to look at.
So like when we went over the airline industry history and then talked about a few different stocks because you had thought airlines look interesting where we are today in the market and stuff like that. Is that the type of format that you like for the podcast?
Yeah. And even when we did things about free cash flow or 100 baggers or any of those sorts of things, we would try to tie it into a specific example that we'd usually use to explain it today. Even when we did like the 100 baggers, we look back at some stocks that might still exist today or something like that.
It was, I think, a huge change that happened for the podcast was probably, 2020 was when we started using Quick FS on the podcast. Yes. And we started taking snap judgments. We started incorporating Quick FS, pulling the financials. I really feel like that was a huge, which obviously, it was completely obvious in hindsight that we should be doing that. And then when we started doing it, I was like, this is fantastic. And Quick FS is great too, because there's no ads on it and it's quick. Like you could just pull the data pretty quickly. There's not a lot of stuff that's on the website, but it was just perfect for the podcast. And because we use the website every single day. But I feel like that was a huge turning point from us because it was a good way to connect with the listeners, see what's on their mind. That kind of gave us a positive feedback loop for producing content ourselves. And we've really kept up with that. So QuickFS has been a great iteration to the Focused Compounding podcast for sure.
And the thing that really changed it was COVID, So, I mean, that's when we started. We never recorded remotely before COVID. We didn't use a lot of these things for COVID. We didn't do more recent ones or talk about things in the news before COVID. So it was really when we recorded more podcasts with a different format, because we had to in the basically the lockdown. That's what changed it. Yeah.
What was it? I mean, the lockdown, we were doing a daily podcast for a little bit there.
Yep.
Because things were just changing so much.
Yep, and that's what introduced a lot of things that we've changed up a little bit. That's also mainly how, like, some people who listen because they found it on YouTube or whatever, that's when they came during that period, basically.
What is a memorable moment from your perspective about the podcast? Is there anything in particular that stands out?
Not really, no.
My favorite moment was, and I was trying to find, because I tweeted it one time, and I had a screenshot of my face when we were talking about Celsius, and as I'm drinking one right now, because it's funny, like Celsius, we're almost branded to the company. People refer to Celsius all the time to us, and we don't own the stock. We've never owned the stock. We've talked about it a good amount. We drink the products a lot, so it's almost like it's tied at our hip, even though we have no financial stake in the business. But my favorite moment was probably when you had casually mentioned that you were drinking like 4 Celsiuses a day, as if it was just like nothing. And my face, I have a screenshot. I'll have to like post it up my face. I was like, what? I was not expecting you to say that. It's just, we always have our weird diets. We're always trying these different things, and like we talk about it, and if it's not drinking a million cups of coffee, it's Celsius, or the all meat diet, or doing the keto diet, or just trying all these different things. I mean, I think at one point we both were just eating only salads, nothing else, and it's just funny to talk about those things on the podcast. But definitely my favorite moment would be when you had said that you were drinking, I think it was like 5 Celsiuses a day. I mean, are you still doing that? What's going on with that? Give us an update.
No, I mean, that would have been when I wasn't drinking coffee, right? So now that I have a pretty good way of having coffee all the time, that's not an issue. I can have coffee. I can make coffee whenever I want to. That's good. Yeah. So, but I'm sure the caffeine intake is still high compared to most people.
How many milligrams of caffeine do you think you drink a day?
I don't know. I've tried to figure that out before. When I go to Starbucks at one time, I had a drink where they asked me sometimes, "Are you drinking this all at once or saving it?" I thought that, I don't know why I would get
like, we got to update our disclaimer.
Yeah. Yeah. I don't know. I mean, I usually have. Well, now it's the thing I have. I make a liter of coffee at a time. It's European, so you can convert that. But that's what I have, and I have it. I always have at least 1 liter of coffee, and then sometimes I have more. So, it doesn't, I don't have a lot of, it doesn't seem to affect me a lot in terms of like, people say that they have trouble sleeping or whatever, any of that kind of stuff. I'm not also a particularly anxious person. So I think some of the symptoms that other people have, are more like amplified, things that they have. So I don't know that I'd be very aware of that kind of stuff,
I'm looking up right now. I just Googled how much caffeine is in a liter of coffee, and this says 406 milligrams. So okay. I don't know if that's exact or what, but that's what God Google says.
Yeah, it's not very reliable. I mean, it depends on what type of coffee and what extraction method you'd be using and all that stuff. That stuff's not even reliable from like store to store. You could go to like different Starbucks make it for you, different McDonald's, and it would be different amounts, But yeah. So yeah, I mean, it's a high amount, I'm sure. Even when I went on any diet or something, I didn't go off of caffeine. So
yeah, I mean, I don't know why. I mean, anytime I've ever cut coffee out of my life or caffeine out of my life, I was absolutely miserable. So I will never ever do that ever again till the day I die.
Yeah, I mean, who knows? I don't notice a lot of negative things about it. Obviously, if you go off of it, the withdrawal is severe. For a brief period of time. But the withdrawal is severe for lots of things. Like we said, if someone went from eating carbohydrates to none, or, from doing whatever thing to not doing it, you have a few days that aren't good. But yeah, I mean, if I had a problem, then I had some health issue because of it, then I would obviously stop doing it. But Yeah.
What drives you to these like extreme diets? If it's like an all meat diet or no carbohydrate diet, is that a personality thing, or what do you think that is?
Yeah, it's a personality thing. I think it's just easier to keep to certain practices. They're not even rules. It's just easier for me. So I don't like. I'm not someone who's going to read the back of something for, whatever. Like what we were talking about with the coffee or whatever thing. So I don't want to be worrying about whatever that stuff is. Diet things are, it's when the diet things are hardest with other people, right? So that's the same. I mean, we have like the meat thing was easy because, we've been to some like business meetings and stuff when I was doing that. And they may notice, but basically you can get something that's just meat like anywhere. So that's why it's an easy thing to do. Then you don't have to say that there's anything or do anything or whatever. So you just want something that's like available everywhere that you could do. Yeah.
Just making it as easy as possible. That's kind of like the atomic habits thing.
Yeah, if you don't eat during certain times or you have to like keep track of certain things or whatever, then obviously that'd be a little inconvenient sometimes.
So throughout the 5 years that we've been recording the podcast, is there a particular guest interview or guest that we had on the podcast that you really enjoy doing? I mean, we stopped doing that probably, I don't know, a year and a half in. Do you wish we brought other individuals on the podcast? Is that something you want to incorporate? Is there anything that sort of sticks out to you from that perspective?
I liked having guests, but I'm not sorry that we don't do it anymore. I think you'd have to do like 2 different podcasts or something, basically. I don't think it's a good format thing. I don't, when I listen to other podcasts or something, I don't really like when it's let's say a panel of always the same people and then they mix in someone else. Who's not like just a guest panelist person, but someone they're interviewing or something. But then a show that's 100% interview. I like that. That's fine. So if it was just a series of interviews, that would be fine. I don't have anything against that. And I think we had good guests. I just don't think it works great for the format of what we're doing if you expect the kind of thing we're going to be talking about and then you get something else. We also tried on the website to incorporate other people writing for it, and they did a good job and everything, but that just didn't work out the way that I hoped. And I think it's sort of the same thing with the guest thing. It has nothing to do with the quality of the guests or anything like that. It's just for what we do, it doesn't work very well. We're kind of branded as specific people and doing a certain style and everything. And if we were a little more generic that way, I think it would work better. But I don't think that it has worked that well. Certainly the response, I feel like, from the audience and stuff hasn't been what I hoped for that. Also, it's a little bit more complicated, obviously, to arrange things and do all that. Then we have some complications from that. So,
Did you like it when we brought on the guest to talk about Berkshire Capital, who was a bull on the stock after a bear report came out on the company, and he gave his own perspective? Is that something that you would like to incorporate more in the future, or anything similar to that?
Sure. So that one I liked in a sense because I felt that we did a more detailed thing through Stephen coming on and doing that. That it wasn't just rumor or whatever things. We did sort of more of a deep dive on that topic, and it was a stock that was in the news and everything. So I do like that a lot better. I don't like a show that's just kind of like a like go through all the news stories of the week and the people talking about it have some awareness. They read some headlines or they, whatever. I would prefer that we cover a few things in more detail, and especially if they're things that other people aren't talking about, or to a different take on something that people are talking about. Right. So the Burford one, I feel like, was more detailed discussing it. And obviously was someone who was more positive on the stock. But besides that, it just was a more, dispassionate, real analysis of the situation and stuff, as opposed to just news things and talking about it that way. So I feel like we handled it in a situation that we handled it from a perspective that was different than most people covering it. So I like that. Yeah.
It'd be an interesting podcast to bring him back on. And I mean, I don't know, what is it, 3 or 4 years since Stephen Gamble's been on the podcast, and be like, hey, what are your thoughts? Do you still own the stock? Have you changed your mind on anything? Have you only gained more conviction? Just sort of an update.
Yeah. And also that was good because sometimes you can have guests who do things that we wouldn't do, and that is one, because I won't really discuss things that are like short things or whatever that much. Some giant ones I've talked a little bit about or whatever, but generally that's not something that I like to discuss. So that's a good one to have someone else on.
Mm-hmm. Yeah, absolutely. Well, 5 years tomorrow on the podcast. So drink a Celsius to that. And we'll see what the next 5 years takes us. We're constantly iterating and trying different things. And this is just a different phase of, we're doing 2-hour-long shows and trying to get the best product out there and the most amount of information within the 2 hours that we are targeting per show. So it's been a lot of fun. I like recording remotely. I mean, what do you like recording remotely? I mean, obviously it's a little bit different. Sometimes the tech side, like the 20 minutes we spent before this podcast trying to get the tech to work, could be a little bit annoying and challenging. And it seems like it never is exactly perfect. But I mean, what are your thoughts generally to it? I mean, the reason I like it is because recording in person, if for whatever reason we weren't able to record, it would sometimes push things back where it's like, well, we're recording remote. It doesn't matter if I'm in, I don't know, across the country or across the world. We could record at a time that we both choose. What are your thoughts generally on recording remotely?
I think it's worked fine. I think it worked pretty well during COVID. At first, there were some difficulties, but pretty well. And this, I think, with what we use now, I think is even better.
The tech's gotten better since COVID too, believe it or not, because obviously podcasting has boomed since 2020. So there's been more tech that's come out and things have gotten better and stuff like that. And I imagine it'll only continue to get better. Yeah.
And we're just two people. I'm pretty used to what we're doing. And so it's pretty easy to watch what the other person's doing and have an understanding of that. In general, though, there's definitely the larger the number of people and the more that they're the same people doing every podcast or something, I do notice a big improvement on podcasts that and video things or whatever that are done in person. Large numbers of people. If you had 4 or 5 people on a panel or something and did it remotely, the energy in a room is a lot better. I also think just if we were tired or whatever and stuff, in person, you're going to get a higher energy level than you are remotely. I think a tired, sick, whatever remote person is more noticeable usually.
Yeah. From our perspective too, right? Like we typically record, here's some, behind the scenes, we record at 3:30 on Wednesdays. But last time we recorded prior to today, we recorded, 11 a.m. And I felt like we were firing on all cylinders. So perhaps maybe we should change it. Cause I get up early and I do work all day. And when 3:30 comes, perhaps I'm a little bit more sleepy and all caffeinated up and a little bit more brain fogged than I would be at 11 a.m. But yeah, you're right. I mean, that's totally true. Maybe sometimes it comes through a little bit more on the podcast, when you record remotely.
Yeah, I think recording earlier is fine and would work fine. Recording 10 a.m. or whatever would be fine for us now. We picked the times that we did mainly so that we'd be least likely to have to move it back. That's basically what we do in the middle of the week because when we had problems, it was usually not in the middle of the week. That was the issue. So, and also we've experimented with like, when's the best time to release and stuff. And it turned out that it's fine to release later in the week and stuff, but for different kinds of podcasts, it sometimes matters a great deal when you release it. I think for ours, it's fine. And especially because we do a longer format now and everything.
So you got a little nice tan there, Geoff. What you been up to?
I was in Florida in.
Is this Tampa Geoff again?
Yeah, I was in Tampa, and I was in I was in Disney World in by Orlando, but mainly Tampa.
So give us the boots on the ground, due diligence, scuttlebutt.
Yeah.
What were they busy? I mean, what are you seeing going on at Disney World?
Yeah, so for 2020, I was there this week in 2020. Not this week, but the week I was there in February was the exact same week in 2020, 2022, and 2023. I was not there in 2021 because of COVID, basically. The park was open and stuff then, but it had restrictions. So I think the big difference this time was the mix. So last year when I was there, it was very crowded. And yet it had and there's a lot of people trading up and heavy spending and things like that. But it was heavily, heavily domestic. It was very American, not very foreign, which is, Disney World normally has a lot of foreign visitors. This time, big foreign. So, which is reflected in the stuff you see about international air travel and all that. It was really poor last year. America had opened back up, but like the international tourism to the United States and stuff was not what it used to be. So it's just a different mix of people. I would say very busy last year at this time, very busy this year. Certainly the hotels must have higher occupancy and stuff. I think that's noticeable. And I think restaurants might have higher occupancy too. I don't know that admission stuff is terribly different from last year, but I think that there's probably more people planning from further away. So they're staying at resorts, booking restaurants in advance, hotels in advance, all that stuff. And that's certainly noticeable in pricing on it, which is different than it was only a few years ago, and availability and stuff. And I think that's driven by more foreign and more far away and a lot less like Florida residents and Americans from other parts of the country. So probably a bigger spend per person would be my guess now versus a couple. Yeah. It is the heaviest I've ever seen that way, I would say. The mix was very, very favorable to high spending.
So when you say from a pricing perspective, are prices way up then and customers are just paying it, or no? Okay.
No, I'd say, for instance, I was in Tampa and at Disney. I'd say there's more inflation in Tampa than in Disney. I mean, if you think about CPI and stuff, they should be up about maybe 17% or something like that from the time I'm talking about in 2020 till now. I don't know that the prices have actually risen 17%. Tampa's risen more than that, I'm sure. Certainly restaurants and things, I'd say double or something, that amount in the 3 years. But that's because Tampa's been more hard hit, I think, by inflation and people moving there and stuff, just as parts of Texas, Arizona, other places like that around the country have been. So I just think the mix, the people that you're getting are people who want to spend a lot. They're people who are coming from far away, people who haven't been there in several years, and they want to stay in hotels, they want to spend at restaurants, they want to buy expensive things. I definitely I'd say that has shifted. Less value, more spending, a lot more trading up, those sorts of things. And it's reflected in their numbers, Disney's numbers, certainly. And, that's just what I think that you're seeing there. And that's also been seen by other parks, other casinos, other hotel things, some other stuff, movie theaters. Everything is seeing higher per capita spending. And to the extent they can trace it, I think it's that they're getting different kinds of people wanting different kinds of experiences as a greater percentage of their overall sales.
Mm-hmm. Have you stayed up to date on Six Flags? I know we talked a little bit about the stock on the podcast and the activist that is trying to make some changes with the company, but is there anything new there or anything like that? I mean, the price has gone up a little bit.
Price has gone up, yeah. I don't know. I mean, I read Disney's transcript, read Cedar Fair's transcript.
I read Cedar Fair's too.
Yeah. And I don't know that a lot has changed since we last talked about Six Flags. But, we talked about insider buying, but that's due to like the requirements that they, whatever. That's part of the expected thing that everyone be buying from the inside. And so I mean, obviously, this period we're in right now, and a little bit the last quarter, is much more relevant at Disney than at these other parks. Disney is it's open every day of the year, and actually when I was there, that's a quieter period, believe it or not, for them. February, because of schools and stuff, has historically not been that busy. I would guess the first week after, the first or second week in September is their quietest, but February is pretty quiet. So if anything, they're busier at other times than when I was there. Although weather obviously is most favorable compared to the rest of the country in February in Florida, but school is the thing that affects it. So, so these other ones like Cedar Fair, it's not going to matter what they're doing right now in February, and it matters a little less what they did in December, November, October compared to Disney.
Yeah, when I was reading their transcripts, I learned that they're a cashless theme park. All of their theme parks are cashless. I was surprised to read that. I don't know how long that's been going on for that at their parks, but do you have any thoughts generally on that? I mean, do you think that it's like a more efficient way to run your parks?
Yeah.
Do you lose out on, with shrinkage, right? Maybe customers stealing money. You could have less cost because it's all done electronically. Basically, it's easier to, keep the flow of everything. I mean, what are your thoughts on that?
Yeah. So like Disney, I would say as an example, the thing that people don't realize probably about the parks, or at least by certainly Disney World, is their capacity to move a lot more money through the system is a lot higher because they don't need to have people waiting in lines as long because of all the technology that they've invested in. They invested in a huge amount of money there, right? Now they're much more extreme than these other companies we're talking about because they do things with the Magic Band and lightning stuff and all that, which means that they're tracking everything and keeping you out of lines and spending money all the time. So that's a huge difference versus a few years ago, is that the amount, the percentage of time of like that you're in the park that you could actively be spending a lot of money is up. And I think that that's useful. So doing things through apps and stuff like that. In terms of people who visit theme parks, I don't know. Some of Cedar Fair's smaller parks, it could hurt them a little bit that they might not use money. But people who visit theme parks are generally people who aren't using cash anyway. So I'm not sure that would be a requirement to be important that they be able to use cash. And then obviously there's security things and all that stuff anyway that are introduced by handling cash, and it slows things down. So, like when I said the Disney things, part of it is that speeding up how you can do a transaction, giving you less options, doing things at a bunch of different things faster instead of making you wait in long lines, but having lots of different places where you can spend, are all things that they do, and that cruise lines do, and all sorts of other stuff. So I've even seen some positive ones in movie theaters along that way with contactless stuff, and also I've been to a thing that that Cinemark might roll out in other places that they probably tested that changes concession stuff, which probably really increases the amount that people would spend because they don't have to wait in lines and things and do it themselves, and it kind of moves them through. And so a lot of them are doing things like that would be helpful. Maximizing the amount of time that people are spending money. Because it's not just that when you're in a line, it's annoying for you visiting a park. It's not very useful to the company because obviously you're standing in a line, getting annoyed and stuff, and you're not spending money. So, that's why I would compare it to casinos and things. They need you betting a lot of money at something rather than just kind of hanging around and doing whatever. So there's all sorts of different things about the mix. And I think that a lot of the technology stuff is certainly driven to do that.
Yeah, I mean, how often do you carry cash on you? Are you a cash carrier?
I always have cash, but I never use it.
Yeah,
I mean, just in case.
Very rarely. I mean, very, very rarely have. And especially now, I mean, you don't have an iPhone, but you could have your credit cards on your iPhone for Apple Pay, and in case that you don't ever have your wallet. But if you're actually watching on the screen now, best thing I ever purchased was my iPhone case that has a wallet attached to it. So there you go. I can never say that I didn't forget, or that I forgot my wallet, Geoff, because I always have my phone with me. So that's the only downside of it. Let's look at Cedar Fair, though. I mean, where we currently are, price to sales 1.3 times, EV to sales 1.3, market cap 2.4 billion, EV 2.34 billion. Would you be interested in this company at where we currently are? I mean, they're back above their pre-COVID peak and seem to be cooking. So I'm kind of curious to hear your thoughts on Cedar Fair. We obviously have spent a lot of time in entertainment, talk about movie theaters, stuff like that. But we haven't really talked about Cedar Fair too much on the podcast.
Yeah, I'm not sure if the price things for the debt is correct here. That's the one thing that I would question because they have quite a bit of debt.
So aren't they 3 times debt to EBITDA right now or something?
Yeah, they have a couple billion in debt, I believe. If you go to their most recent quarter, it might show it. It's not showing up. That's probably why. So it's not capturing it yet. The balance sheet isn't in there. That's why. So do we know what their debt was like a quarter before? The September quarter it has a full balance sheet for.
Yeah, they had 2.2 billion in debt.
Yeah. So you have to add that on. So that would make it trading more in line with what I know the other parks are trading at. Generally, it seems like parks are trading at 2 point sometimes EV to sales. Given that a lot of these have over 20% operating margins, it's pretty cheap compared to stocks generally. It's not bad. So historically, let's see, their EBIT margin has been in the 20-25% range.
Mm-hmm.
And then the EV to sales is not much different than that. Much different in the sense that it's not probably much more than 2.5 times or something like that if we added the debt. And I think that's in line mostly with what I've seen of like Six Flags and SeaWorld and some other ones. If we you have to adjust for different things with each of them. Obviously, this is a company that normally distributes its earnings, and so it's said that it's going to start doing that again. And once it does, they even said, I think in the transcript, that they'll see how the market reacts to that. Maybe if they don't get enough credit for it, they'll buy back stock instead. But historically, they didn't buy back stock. Instead, they paid out. And so they kind of tended to pay. They tended to be priced at sort of a premium to some parks because people like those distributions.
They bought back a lot of stock too last year, didn't they?
Yeah, but I think that's just because they weren't paying the distribution that they had been before the pandemic.
Mm-hmm.
So I would expect them to shift that and not do that anymore.
Were you surprised to read that they were going to wait and see how the market reacts to their dividend?
Maybe a little bit.
Yeah, that caught my eye.
Yeah. Yeah, we'll see. I mean, historically, they did that all the time. So it wasn't a question of it. But it is an interesting question now. Things may have changed a little bit in which they don't get as much credit for that now. The market's attitude towards things like dividends maybe has shifted somewhat. I think that there's probably more value in buying back the stock at the prices the stock was at before. In general, I think there's probably more value for a company like this to do that. They also, they have a limited flexibility if they pay out in terms of they need to make investments in the parks. So they have to have debt because of that. So, buybacks could be more whenever they want to, but the payments to the unit holders would be a regular thing. And so that can sometimes be a problem for some companies if they have to be borrowing all the time no matter what, right? Because the cost to borrow now for long term is a lot more expensive than it used to be. And, if they want to invest a certain amount and they said that they're paying out so much to the unit holders, then they're going to have to take on debt to do that. If they want to make big investments in some parks this year, because, CapEx can be lumpy for new things, then they could just not buy back stock this year or something, So it would let them kind of target their debt levels maybe more. And they probably have looked at other companies in the same industry and seen that not paying any dividend hasn't been a big harm to them. So
are you for or against, or maybe just it doesn't matter to you, publicly traded LPs? Like, would you go into investing in Cedar Fair with a different mindset than you would just a normal public company that isn't an LP?
I mean, because of what we do, it has an effect on that. And so I think it has an effect on lots of money managers and stuff like that, whether it's LP, LLC, things that there's some companies I don't talk about really on the podcast because I've said to people, look, you're probably not going to buy this because of tax things or whatever. For people in general and stuff, it would be better if there was more of these things and people bought them the way that it used to be. But the way that the market is now, a lot of the market isn't made up of like individual investors buying and holding for the long term. And so I think some of these publicly traded things that do this are at a disadvantage long term. There's lots of I see lots of companies that make decisions that from a tax perspective are negative, but are positive from getting interest in their stock, So, I mean, one of the things I find interesting is if you look at some companies in the same industry in the United States, some use LIFO, last in, first out for inventory, and some use FIFO, first in, first out. From the perspective of making the most money over time, creating the most wealth, whatever, for their shareholders, in those industries where they do that, they should all be using LIFO. So the reason why they're using FIFO is because they want to report higher earnings. So the only way that they can get to pay lower taxes is by reporting lower earnings. They're not allowed to report the most aggressive way for earnings that way. What's interesting about it is if you look at what companies are doing it, it's the companies that are probably a little more concerned with what Wall Street thinks about it and whatever, and more growth oriented, less likely to pay a dividend, all that stuff. And the other ones are more older and they've done it from before. So, there's some things, some of these companies, some of them have, there's advantages to doing it a certain way. There was one, but people won't buy them. They just won't buy the stock. So like, I was talking to people about one stock that there's just I don't think there's any chance that they'll buy it because it's a LLC instead of being a C Corp. So this complicates things. But usually it's a good sign if you see this is just a structural thing, but at companies, usually it's a really good sign if you see a lot of care taken about taxes and stuff and not a good sign if you don't. So those are always interesting. Like, I saw a company that was structuring things so that it could pay quite a lot in dividends as a return of capital instead of being as if it was earned. But they've paid a lot out over time that way. And so they've been careful to make sure they do that. But it's the usual sort of thing in that it's a lot of insider ownership, right? The same ones who pay large special dividends are always large insider ownership. There might be more lawyers, more accountants, whatever. They're not like, people promoting a stock to go public and, doing all of that. So,
do you have a preference towards any? Have you ever invested in an LLC, like a publicly traded one?
Yeah, I do not look at them basically because of, our situation. As I don't for some other things, I learned this when I did the Japanese nets, when I did some other things. I did some things personally that complicated some tax things, and other people won't do it. And I literally mean complicate. It does not cost more in taxes. It just required more things to be filled out or to wait for something or whatever it might be. So for instance, there's IRS rules about foreign companies that have that are basically like cash shells effectively, right? And things like that. And so there's more complicated rules that you could fall into if you're buying things in other countries that other people would never think of, that you have this rule. So a lot of these fall into that kind of stuff. We're not going to do things that are going to probably result in complications for taxes and stuff for people. But the same thing's for reporting things. There's some reasons why we wouldn't buy things up to a certain level or whatever for SEC stuff purely for reporting issues. So, it's just something you learn in the business.
From a business perspective on our end, we were doing something one time and you're like, no, you asked me to ask the accountant something. I got the answer and they gave an answer you did not like. And you're like, no, I get that they would tell you that, but I'm saying, I don't think that's the only way to go about doing this. The way that we could go about doing this would be more complicated, but that doesn't mean it's the wrong way of doing it.
Yes, because what accountants will sometimes tell you is do this thing, which will actually be less tax efficient because it will simplify things and put you in line with what everyone else is doing. So, pay attention to what people, whether it's Berkshire Hathaway or John Malone in his career or any of these people that you look at, they're usually very efficient about those sorts of things, whether it's tax things or other things about giving up value to other people and all of that. You want to make sure that you don't waste stuff that way. We talked about this with the deal that they did with Keweenaw Land Association. So if you look at that deal from the perspective of the buyer, they paid an incredibly high price in terms of what they got, because instead of structuring it differently, there's a gap there. And so obviously the price that they paid the seller needs to get a price met no matter what. So if some of it is going to the government because of inefficiencies in how it was structured, that doesn't give you a cheaper price. It makes it worth less to you, but the seller isn't going to sell to you any lower because of that. And that's just an indication. But that was an institutional buyer. So yeah, I think institutions often don't maximize tax efficiency because you don't get a lot of credit from it from your clients. The same thing is true when we talk. There's things. I talked a little bit about this, but if you think about it, like you could have things run from a managed account perspective that could gain you some percentage overall just because of making sure that it structured things properly in terms of maximizing tax efficiency, because it would have so many different positions, some of which would be gains, some of which would be losses. This is something we don't have, unfortunately, because we have such concentrated positions, such few positions. Obviously, we run into the problem that we tend to have a lot of the time our positions are in gains. We don't have offsetting losses for them. But if you're super diversified, as many people are, then you could have benefits from that, and there might even be benefits to churning some things. But you won't get any credit for that if you do that. If you save people tax, they basically pay you on pre-tax results and stuff. So you'd have to create a whole strategy for some high net worth clients and things, being like, this is what we do for you. You're not going to otherwise get credit for it to save people money on taxes. And you will get punished for increasing any sort of complexity for them. So you're just creating a reason why they might leave you. So,
I mean, even remember, we have talked about Beaver Coal on the podcast, and from being a fund, it would just be more challenging for us to buy that company, just from a tax perspective. But as an individual, it probably would have worked out great. I actually think the stock's up, way higher than where we were actually very interested in it, but passed just because of structural issues, right? Nothing to do with the business itself, but just more so the entity that we're using to invest.
Correct. And, I've said that to people before, like, as an individual, if you can handle this, they're the biggest advantages, because if someone's not buying something just for a tax reason or just because of how it'll look for whatever reason, or, whatever, then that's a good reason to buy it. That's an advantage to have. If someone's less likely to buy something because it's unlisted or because it's not technically a stock, there's some weird ones that are sometimes attractive because they're actually some sort of trust thing, or certificate of whatever. There's a few things that trade in the United States, which people in their write-ups refer to as stocks, but they're not stocks. They give you different interests in things, which could be interest in royalty things that you have. They could be interest in whatever different things. They may be things that don't attach any voting rights to it or restrict you in other ways and whatever. And a bunch of them were set up for to resolve some sort of issue in the past, right? So someone who was probably a larger shareholder or group of someone's needed to be compensated in some way, and so that's why they created it.
I think we were in the area doing some work on Beaver Coal. What was it? Summer of 2020. And I mean, just looking on here, we were talking $1,100 per share, and it's currently up to $3,200 per share. And because of what? A structural issue that pushed us away. Nothing to deal with the investment itself, management, nothing. It was purely
definitely
a thing. I mean, and everything that we why we focus on overlooked stocks too, right? Is because larger company or larger funds won't focus in this area. And even us being small, it presented an issue where we weren't able to carry out an investment that we wanted to make.
Yeah. So, yeah.
But that's a good advantage for individuals, everyone listening, right?
Yes, because if you go through some of these things and look at what's the stuff that they're passing through on the tax things, this is not necessarily this is highly taxed stuff or a disadvantage. In some cases, there's favorable stuff. It's just that it's more complicated, right? And I don't know that. I mean, but you can definitely tell, because look, if you go to corner of Berkshire or Fairfax or any of those sorts of things, people may forget what stocks made the money and what lost the money and stuff, but they'll never forget what stocks complicated their tax and stuff. So,
yeah,
it's sort of like with the merger things, if they feel they got a bad price from some management, that did a management buyout or whatever sort of thing, they remember that they feel that they got screwed on that thing. But they often forget that they made a bunch of money too, because they bought it cheap and they got a premium or whatever. But
it's that last 10%.
Yeah. So it's the same sort of thing. It just is a bad feeling for people and stuff. And now so much of everything is passive and so many people are so widely diversified. I think it's different. A long time ago when people would buy these things and then sock them away somewhere. And that's what a lot of the original owners and long-term owners and all these things are for, that are the larger shareholders. It's not a problem. But yeah, for the little shareholders that we're talking about, they're not used to doing anything that isn't a stock that doesn't complicate things at all. So.
Got it. Did you watch the replay of the Daily Journal meeting with Munger?
No, I did not.
Okay. No. So you'll have to listen to it. It was funny. 99 years old, and he was spilling some wisdom, as he usually does. I thought it was pretty interesting. He said a few things that I wanted to go over on the podcast. So people brought up Alibaba, obviously, as they usually do. And he actually admitted that it was a mistake. One of the worst mistakes he's ever made, I believe, is what he had said. And we'll go through it here in a second. These are transcripts. Kingswell, I'll put the link in the description. This guy took some time and transcribed it. It's a long document, so I wanted to give him a shout out. So that'll be in the description down below. But somebody had asked him a question about Alibaba. It says, according to company filings, it appears that Alibaba shares were purchased with leverage. And when the stock price fell last year, you were forced to sell. Can confirm if it was bought with leverage, and if so, why would you do that? It seems to go against your philosophy. But I thought it was interesting, this part right here, when he was talking about if you come across just the complete no-brainers, how much he'd be willing to put of his net worth in an investment. He says, if you're the kind of fellow who's right when you think something is a cinch, the answer is 100% or maybe 150%. But nobody teaches people to think that way in finance. If the opportunity is great enough, the logical answer is 100% or maybe 200%. For someone that talks about ladies, liquor, and leverage being able to destroy you, he certainly has used leverage a few times throughout his career.
Yeah. I mean, he did an arbitrage trade, which was like 100% or more of his partnership in one deal. Yeah.
He talks about Berkshire. He said Warren in the Buffett partnership used leverage every year. He said what Warren would do is he would buy a bunch of stocks and then he'd borrow against those stocks and he'd buy into what they used to call event arbitrage, liquidations, mergers, and so forth. That didn't go up or down with the market.
Yeah, I've said to people, I would buy those on leverage, I would say, to use leverage when buying those. I mean, I don't recommend that. I never recommend leverage to people because I don't know how they're going to use it and whatever. But I think we talked about a preferred stock before. And I said, look, this is a good purchase if you do it with leverage, but it's not if you don't. Because, I mean, it doesn't make sense to buy a guaranteed practically, 9.9% return or something without using leverage. Because you can go and find other things that can give you pretty similar returns, not necessarily as good risk-adjusted returns, but what does that matter to you to have zero risk in the long run versus having slightly more volatility and stuff? It doesn't. There's a point at which that's too far, and so, yeah, it would make sense to leverage that up. We talked about Davis Dynasty. He applied leverage all the time to his So, I mean, the only thing I'd say about that is I always tell people, like, look, I'm not for saying use leverage, use margin stuff, whatever, but if you're buying companies like TransDigm or like whatever, I don't see what the difference is of doing that where they have the debt on them and they're leveraging up a very predictable, very stable, whatever business, but with a ton of leverage at the corporate level versus you doing that and applying it to a business that is, that you think is super predictable and stuff, but has no debt on it. I don't understand the difference. So there's people who will say, I'll never use margin debt and all that. And, and then they'll buy Carvana, right? instead of I'll use some margin debt to buy this preferred stock in this thing or to do this, when we talked about the Hunter Douglas thing or the Activision Blizzard thing or what, the different merger arbitrage things. Yeah. I mean, I think Buffett would put about a quarter of his portfolio into merger arbitrage and he would offset it with debt. And I think Graham Newman believed in using debt that way. And
Somebody had asked about Occidental Petroleum, which we spoke about a lot about last year on the podcast. Will Occidental Petroleum and Chevron be long-term holdings for Berkshire going forward? And Charlie said that is a very good question. I think having a big position in the Permian Basin through those two companies is likely to be a pretty good long-term hold. So I like that aspect of that position. Ben Graham used to say, if it's a good investment, it may be a good speculation. And I think that's generally true. But I don't do those short-term speculations, at least not very often. But I like the big position that Berkshire has in the Permian through those two. I kind of admire both places a lot. Both Occidental and Chevron are very admirable places. By the way, Oxy didn't start like that. If you go back 30 or 40 years, Oxy was run by a crook. It's evolved into a wonderful place, but it started as a sleaze bag.
Yeah, that's true. You can probably look up the history of Occidental and stuff, but yeah.
I thought that was funny. What do you think about that quote he used from Ben Graham? If it's a good investment, it may be a good speculation. What does that even mean?
Yes. So, I mean,
because we've talked a lot about intelligent speculation on the podcast, right?
Right. So Ben Graham, first of all, Ben Graham's definition of investment is different than how a lot of people use it on this podcast or whatever, as being long term or any of that kind of stuff. So, but it is true that if it's a good investment, then it also could be a really good speculation. If, say, you're buying cheaply, so like for instance, there's well, I'll tell you one that this would fall into is we talked about A-Mark precious metals, right? Mm-hmm. And I did a write-up of it where I said, look, like there's not much, the market is putting very little value. It's a little bit of positive value. Like if I say, what is the investment value of A-Mark precious metals without the issue of the market in precious metals being it, so just the lending business and stuff that it had, that accounts for most of the value that the market had on it at the time. Mm-hmm. So you were paying a very, very small amount for the possibility that there would be a good year. The same way that if you could buy into an investment bank at some tiny, tiny fraction of book value or something, even though it might not you might not have any idea that it would make money, there'll probably be a year that's good for whatever thing they do with their bond things or their M&A things or whatever thing they're in. There'll just be a good year and it'll go up. And so, I think that's what he means. That's how he got his start in, when he talks about his memoir and stuff on Wall Street, is by suggesting buying defaulted, bankrupt railroad stocks that were trading at a value that was inappropriate versus an option. Now, today, people have very complex methods for how to value options and stuff, and so you wouldn't have the same opportunity. But back then, what often happened is that after a stock was bankrupt but was still trading, the company was in bankruptcy but it was still trading, they knew that they would get some sort of thing in terms of converting into the new stock. It was going to be massive loss, but it would be somewhat positive that way. And so if there was a good period for the railroads before the conversion happened or a few years after, whatever, you bought it and held on, then you could make a lot of money because you can only lose, say, 10 cents, but you can make $1.50 if it works out. And, that's warrants and stuff like that. So, and I think that's true. I mean, I think if I see a stock that's a good investment, and there's warrants outstanding, then you got to look at the warrants.
Mm-hmm. Yeah, A-Mark precious metals. We were talking about it in 2020, right? Around $4 or $3 a share. And it's up to $31 here today.
Yeah, and so I forget if it was about 70% or so of the value was hard investment value, like a value investor would gladly pay it. Mm-hmm. And then you were paying a small amount, a few dollars a share. I don't remember if it was $4 or $3 or whatever, but like that was the amount that was the speculative portion of it. And that's because they had a business that was like lending, secured lending and stuff like that. But then there was another part, which is the spread business, which if they ever had a good year. And that you could see because in past times they'd had once in a while had a good year. We mentioned Friedman Industries. That's a classic example because it's often been a net, and people go, "Oh, what will ever happen?" So, well, if it's ever one good year for steel, the stock will go, it'll like earn its market cap in it. Yeah. And so, of course, you'd say, "Well, I have no reason to believe there will be a good year in steel," but sometimes there is.
Over your 10-year time frame, and
and a lot
if
of
that
times
can go up 3 or 4 times, that could give you a really good IRR.
Yeah, and a lot of times you get paid for that because if you buy things that are good investments, right, but they're in commodities or whatever, if they have a good year, then the stock will suddenly be valued very differently. And so if you bought things because you thought they were cheap versus their reserves or whatever, oil things and stuff, then a good year for oil is very helpful for you. It's helpful to pay a low price, and it's not a dumb idea to pay a low price for some things that are speculative, whether we're talking about land things or we're talking about commodity things or whatever. We don't know what will happen with them, but if you pay a really low price compared to like what they're likely worth in liquidation to another buyer, whatever, we talked about cement things on the podcast, right? We didn't know what happened with cement or something, but you pay a fair price for a good price for a cement company. And then if there is a year where it's good, it works out. Frost, total speculation in that you don't know if interest rates will go up or ever. But when I wrote that up, I said, look, it'll earn 10% a year return on equity if rates stay at 0. And if they go to some big number like 4, and now they've gone over that, then they'll suddenly earn a ton more. And so it's a speculation, but it's a speculation where you do fine on the downside and then you make money on the upside that way. Yeah, I don't like the speculations where you're paying a really high price for it. So like now buying, we talked about the coal things. Now buying coal companies after coal went up a ton and their stocks went up a ton. It might work out if it lasts another year or two or whatever, but it would have been really nice to buy it when before coal went up so much. Then you'd be doing better, and the coal for steel making and stuff. So,
is there room for that in a portfolio, you think? Maybe you don't structure it a 20% position, but a smaller position that if you feel like, hey, if this hits, this could go up 3, 4, 5 times.
It depends.
Because we come across a lot of ideas where you're like, yeah, I could see how this could work out.
I would do it myself.
Mm-hmm.
I'd do it myself. When you and I talk about like, well, how'd Buffett make all that money on the side thing? And I said, well, some of it, and I've talked so much about how much I like A Man for All Markets, and I think people are baffled by that because A Man for All Markets doesn't invest at all like the way we do. But there's a similarity in some of the things. So yeah, I mean, if it was just me investing, not in a fund, not in managed accounts, not for a long-term thing, whatever, that I could just buy something and just forget about it or whatever. Think of each one as its own bet. Yeah, I would buy some things that would strike people as odd. Mm-hmm. I think nets always strike people as odd when you do them, because the argument is always, well, how do you get your money? Mm-hmm. And I don't know the answer to that, but it is a speculation in that like something could happen. I'm a little more aggressive on that than some people. Like we did. One of the things when Quan and I were writing stuff up was on oil related stuff. So two of the areas we looked into where I thought some things were. We both thought that some things were out of whack in the economy, in that there was a period where oil was sort of overpriced and stuff. And there was a period where interest rates were lower than they were likely to be in the future. So looking at that, we thought of companies that would benefit from lower oil prices. That's why we looked into cruise companies, for instance. And for me, I would be willing to buy totally on the basis of ignoring the current price of something, in that case, oil, and going totally with the price we assumed. So oil, when we were looking at it, was, I forget if Brent was 110 or something like that. My memory is it might have been around there. And we thought it should be between 30 and 70 long term. So I would plug in 30 to 70. Mm-hmm. Yeah. With Frost, I would plug in 3 to 4%. Like I was in favor of plugging in 3% Fed funds. You have to kind of discount it or whatever for a little while in the sense that you're not getting it now. Yeah. But I don't think it makes sense to say that today, whatever data point we're on, is more accurate than our estimate of the long-term average. So, if they can survive and stuff, right? So like, there was no threat of that with Frost. There's other ones where I would disagree because, an example was there was a company that was cheap that did offshore. It rented out equipment. It basically rented out equipment for offshore drilling, and the problem is that you lose a lot of money on it when it's not being used, and so it was probably trading below liquidation value in a good market. But the problem was it burns a lot of cash and everything, and you have no idea if it would survive long enough to be in a good market. And so I wouldn't buy something like that. It's maybe a good speculation. I don't know. I'm not comfortable with that. I wouldn't be comfortable with a bank that I thought was going to go out of business if rates didn't work the right way within a few years. But if they can work at 0% and they could do a lot better with it being a lot higher, and when we're looking at the cruise companies, they were making money when oil was very, very high. So that's actually not the thing that did them in.
It's back to the extreme points.
Yeah. So I don't have a problem with that, with investing in things because you think that there'll be some huge rebound or whatever. If you think that it'll survive, a lot of these are that I'm not sure if it'll survive. Mm-hmm. And the other thing is I like to base it on the economic logic of it. We talked a little bit about this, but like the ones I don't like are like Graph Tech, which we talked about on the podcast, right? So the problem with that is there was a contract in place, but the economic logic of it didn't make sense for people to actually take to keep to the terms of that contract, right? So those are tough. Whereas like when people would compare that to NACO, the difference is that those mines and those power plants were co-located so that it made economic sense, right? I never want to rely just on like a contract, you know. So I don't know, but Buffett has done speculations. He speculated on silver purely on the basis of supply and demand stuff. So,
do you think he gains a lot of insight into all these other markets just from running Berkshire and receiving all the data points from their subsidiaries? I mean, he's soaking in so much information every single day that doesn't get widely reported in the Wall Street Journal every single day, just from ordinary course of business.
He might. It's possible. I mean, I think it's possible, but I don't know where he would have like very high frequency stuff that other people don't have or something like that, you know.
When he's doing things with silver, is that more just like he's looking for the extreme supply demand imbalances?
Yeah. So some things you look at and there's obvious discrepancies between supply and demand. Now, there could be ways that it's resolved because we don't know enough about other things around the world and stuff. So like, you know, you could look today and say, okay, there's a supply demand issue with uranium in a few years. Yeah, but like there's huge producers historically that are outside the US and stuff that I know nothing about. So I don't know that will not be resolved in some way over time. You know, and a lot of these predictions don't look good over time if they're not so value based. Like the issue with the oil thing and stuff is it's pretty hard to predict if you don't know the price. Like people predict like what will supply be in the future and stuff. If the price is high enough, they'll look for it and they'll find it. You know, so
capitalism works.
I don't like that. And as you know, I don't like the when they tell you their cost. Right, that's a big thing is the cost thing. And it's fine. Like I think you can do like relative costs of some things, but actually it's pretty hard for some cost things because in a tight market, it would actually cost everyone a lot more. So I think that isn't the best. You know, I don't think that's the most reliable number, to be honest. Like right now, what we have is like, okay, so if you need to have more, you know, if demand for like oil field services stuff now or whatever, I mean, it would have to be more expensive than it would be, you know, in the last bust, right? Because just like employment overall is so tight right now that shifting to being able to use anyone it's really tough. You know, it would be like a restaurant saying that like, oh, this is how much it costs us to hire one more person or something. Yeah, it's a lot more expensive now when you're trying to do it at the same time while your competitors are trying to do it. So usually the costs are much lower in a bust than in a boom. So that's a part I don't love when they do that.
Becky Quick had asked him, can a great business be run by a lousy manager? Obviously, they fielded questions. And he said, sometimes Coca-Cola was run for years by a man with severe mental impairment. The directors just assumed he was drunk and let him stay there year after year. Now, that's my idea of a wonderful business. You could be mentally defective and run it pretty well. That was Coca-Cola in its heyday. And then she says, how far back are we talking? And he says 25 years. And then she says, I'll let somebody else do the math on that and figure out the timing, like who it was. Thought that was funny. We could go down. Let's see what else we got here.
Berkshire's admitted they had a few that they had people suffering from dementia and stuff that they still had in their position.
Why do you think that is? Just
they're reluctant to remove them.
Yeah.
I mean, Buffett's literally, we know some examples where they've named the person, but Buffett is literally given that as an example when he says why he has to fire someone is because of them suffering from dementia and stuff. So
let's see what else we got here. Sorry. Oops. Baba. Let's see. Said, I regard Alibaba as one of the worst mistakes I ever made. In thinking about Alibaba, I got charmed with the idea of their position in the Chinese internet, and I didn't stop to realize that it's still a goddamn retailer. It's going to be a competitive business, the internet. It's not going to be a cakewalk for everybody. So as he reiterated, rubbing his face in his mistakes, he considers Alibaba a huge mistake.
Yeah. It's a popular one with investors following him and stuff. Certainly I hear a lot of value investors talk about it. It's one of the most common things I get asked about, even though, you know.
So what do they do now
stuff.
if they're like, oh gosh, I mean, are they bag holding because they've been holding it and they're like, oh gosh, now Munger's coming out and saying that it was a huge mistake. That's the problem of stealing other investors' ideas, right? Like, what do you do? I mean, clearly he had his own investing thesis, and when that was broken, he got out. But if you stole his thesis, what do you do? Now you're just putting your head in the sand.
Yeah, but also it may work out for you if you do put your head in the sand, because it's different price and everything. That's part of the, sometimes it's a good idea to steal ideas after they've sold out or that have gone badly for them or whatever too. It really depends on what they're right and wrong about. We talked about it though. I mean, there's evidence of really tough competition there for Alibaba. That's what we talked about. That while it was very fast growing and it's huge and everything, there's just really strong evidence of competition there. And so that's a tough business. And usually, certainly Berkshire, probably Charlie, do not invest in businesses like that. They certainly don't invest a lot in retailers, and the record in retailers is pretty mixed. Except for the ones that truly dominate enough in a local area or something like that they don't face a lot of competition. But highly competitive retail things they've had trouble with, and really their retail things that have gone well have been having a great manager, and then they didn't do so well when they didn't have the great manager there.
So somebody asked about just investing in general over the next 5, 10, 20 years. Charlie gave an answer, and he said, I don't worry much about it because I'm going to be dead. It won't bother me very much when I'm lying there dead. And then she said, I guess you want to point out to people that you're 99 and nobody lives forever. That's what you're referring to. And Charlie says, I'm 99. That's right. Becky asks, so you're not sick at the moment, right? He says, nope, because he was just chomping away on peanut brittle. He said, nope, I'm eating this good peanut brittle. That's what you want to do if you want to live to be 99. I hate to advertise my own product, but this is the key to longevity. And he held up a piece of peanut brittle from See's Candies. And then she said, somebody asked, do you think exercising a lot when you're younger is important to longevity? Charlie, this was so funny. He said, I have done almost no exercise except for when the Army Air Corps made me do exercise. I've done almost no exercise on purpose in my life. If I enjoyed the activity like tennis, I would exercise. But for the first 99 years, that's funny, first 99 years, I've gotten by without doing any exercise at all. And then Becky asks, and you're not planning on changing that anytime soon? Charlie says, no, I'm not changing it. That's funny.
Warren's not big on exercise either, obviously.
What the hell is wrong with these people? How are they living this long, Geoff? It's got to be stress, just lack of. I mean, we've talked about it before. Buffett hasn't had to, the average person may think about money, paying the bills, whatever, kids. He hasn't had to think about any of that or has had any stress financially since his, late 20s, maybe mid 20s. He's been rich basically his whole life.
Correct. Yes. Yeah, I mean, there's some research on stress stuff. The thing that's complicated about it is it mainly seems that the issue is like how you deal with it. So it's not necessarily that stress is, for some people, for people like Charlie and Warren, I don't know that stress, how do I put this? What many people would perceive as a lot of stress being put on them, they don't feel is very stressful. They have a way of dealing with it that isn't very stressful. Whereas some people who we would say are not very stressed manage to be in a state of as if they're highly stressed. And I think it's that state that they're in that's more their ability to deal with it. So it's not just how much you have to deal with, but also how you deal with it, right? Yeah.
So like you're saying, people could look at Buffett and be like, oh my gosh, you have so much responsibility. There's so many people that rely on you. You probably feel the pressure or you feel so stressed. And he probably looks at it like, no, not at all. He loves it. Wakes up and tap dances to work.
Yeah, I mean, Munger had some wealth from real estate things and stuff early on, but he had a few years where it was very hard getting back to making money for his partners. I'm sure that was very stressful for him. Buffett had the Solomon experience and stuff, so there's things that were more than they probably wanted to handle. And Buffett stopped doing the partnership. And he never would have agreed to stay on at Solomon and stuff. So they also won't take on, they won't continue to maintain too much stress for them,
Somebody asked, how was Rick Uren as a person, as an investor, and how do you remember his legacy? And I thought it was nice. He said he was just terrific as a person, as an investor. I miss him terribly, of course. We were together for years and years and years, and we were poor together. That creates a bond. When we met in 1961, we were both poor and struggling and young, so we had a long ride together. But all things end. That's the nature of the human condition. Which was a nice tribute to him. But anyways, you should watch it. The replay is on YouTube. I also tweeted it out, and then I'll put this transcript in the description. It was great. Hopefully next year they'll have it in person, because I was gonna say we should go if this one was gonna be in person this year, because there's some companies that we'd be able to see while we're out there.
Yeah.
But so we'll see. But we could jump on forward on the podcast 5-year anniversary.
Okay. Mm-hmm.
We've been getting a steady flow of questions from people, which is great. You can send your question to focuscompounding@gmail.com. I'm kind of, let's see, we got about 40 minutes left. Yeah, we could see if we could blitz through these. So somebody sent us a snap judgment, and we will pull it up. SFBS. I think this one would be good for the pod because it looks a bit different from the typical bank. Not cheap, but maybe justifiable if future looks like past. Decentralized, banker-centric rather than market-centric, i.e. they expand where they find good human capital, growth model, seemingly huge deposit per branch, good growing southeastern markets, decently diversified loan book allocation between mortgages, commercial real estate, construction loans, and C&I, pretty levered equity / assets and loans to deposits. Unclear on the quality of their deposit base given their limited branch network. That could be something Geoff might spend a minute expounding upon. Some rules of thumb on the topic in terms of how one gets comfort on the quality of deposits when looking at banks. And we could pull that up in QuickFS.
Mm-hmm. I believe I know this bank, and I believe I read their transcripts and their 10Q and stuff. Is this Service First?
Yeah. Mm-hmm.
So I looked at this bank and passed recently. Some people asked about it and stuff. And I said I just pass for now because I was concerned about deposits. So I was concerned about that some of their deposits were from other financial institutions, and that those left the bank at a higher rate than the bank had predicted, basically. And so there's just one line in the 10Q that you could get that from that was just like an alarming line that it had. So I think that they're experiencing a degree of stress to their deposits that is, sort of unprecedented and not what they were expecting and stuff. They didn't put it that way exactly, but that's how I interpreted that line in the 10Q. And I don't have it in front of me, so I can't find it exactly. But basically what they said is that, while they had expected it, it happened at a higher rate than they had expected. So it was very large.
Are these wholesale deposits?
Yeah, so it's like correspondent banking deposits. Yeah.
Mm-hmm.
Mm-hmm. Yeah. So, I don't know. I mean, this is... Most banks are pretty relaxed about this compared to my concerns about it, have been for the past year. But that I'm somewhat concerned about the possibility that deposits would leave some banks that have a lot of loans, so have a high loans deposit ratios, and the risk that presents to them in terms of how quickly they think that rates will come down. And, it's a different situation, but we even talked about this with First Republic, the San Francisco bank. Because if you look, until about the beginning of 2022, I think that from the start of the pandemic on, Frost and First Republic were probably trading similarly. They're very similar banks in a lot of ways, but they're very different in terms of their the sensitivity to the asset liability stuff. In that First Republic is much more doing I don't know if it's 90% or whatever, but loans to deposits is very high there, and so they're putting it all into loans, and they are less concerned about that than maybe I would have liked to have seen. And then they did this thing and the stock went down a lot, probably I think because of some things they saw with the CDs where they were very targeting specific times of sort of the Fed's presumed pivot, I think, because they didn't want to pay too much for money to do that. And also probably because they didn't want their own current banking clients and stuff to switch over to those products that were paying much higher rates and stuff. So it was a way of doing things that might be might work out better for them. But they did a lot of specials on things and stuff. So and I think I take that as a sign of stress in terms of the deposit situation there. So the bank is interesting. Service First, it has grown rapidly and much more rapidly than banks that I normally invest in. It's largely organic stuff that we're talking about. And it has been a little bit expensive stock, but a very strong business performance. But you do have the possibility about the deposit situation that we were saying. I think it's more lending focused bank, and we could talk about that, like the distinction between different banks about whether they're focused on bringing in deposits and stuff or whether they're focused on making a lot of loans in that area, and then what that means in terms of how they get their deposits and how they think about certain things. And I think it can be a very big difference between banks. Generally, I think it's easier to invest in banks with confidence for the long term, where most of the value is on the deposit side. There is a lot of money that can be made from banks that focus on being very efficient and being good lenders, but it does present problems in times like now.
Mm-hmm. So on his last question, how does one get comfort on the quality of deposits when looking at banks? We spent a good amount of time on this, but do you want to expand on that a little bit?
Yeah, so I'm not really comfortable on this bank with the quality of the deposits that way. So what we're talking about is really the marginal stuff, is how marginal it is, how much will flow out and or in, how hot the money is and stuff like that. So we're not talking about, like, obviously at most any bank, there's a base that is probably pretty safe and whatever.
Like individuals.
But yeah. But like if you're lending almost everything, right? So you have close to 100% loans to deposits or something, and 20% of that is really hot money, then you got a bit of a problem, and you could say, and they could do presentations and stuff and tell you how great 80% of it is, that 4 out of 5, everything is all this stuff that's very sticky. But if 20% isn't, then, you might have a problem. And obviously if you're trying to grow very fast and all that, then, it's then that's the issue that you face. They, like you said, they have huge deposits per branch. It's a question of how they got those and where they get it from. You could talk to them. You could try to learn about the bank and all of that. Obviously, trying to promote yourself in ways that don't have to do with necessarily very big clients, right? And necessarily tied to like rates and things like that would be better. So a large base of smaller businesses, households, things like that would presumably be better. And a way of presenting yourself that doesn't focus on the costs involved and all of that would be good. But a lot of it is pretty similar from bank to bank, depending on where they're getting the money from. Yeah, I mean, when I break it down and stuff and talk about the deposits, what I'm really talking about, I've said is, we're looking for deposits from households and businesses. And more weighted towards transaction stuff, which is to some extent the opposite of what regulators talk about that way. But I actually don't think that time money is a good idea to the same extent that some do. Like if you read the book Capital Allocation, there's a discussion of how time money is more reliable than transaction stuff because that's demand stuff. But if it's tied to transaction-based things, I think that it's a lot stickier over time. And then you can always raise rates when rates come up, just not by as much as you have to. Like people say, like, so like say with Frost or something, right? Like, how fast will money leave the non-interest stuff that they have? Well, but then like you can raise the interest stuff faster than other banks are if you have a lot of non-interest stuff, right? Because like So you have a ton of non-interest stuff, and then rates go to 4 or 5% or whatever. Well, then you try to move people over to the stuff that does pay interest and that is yielding small amounts. I mean, if you said, okay, let's go to 2%, well, 2% is giving you the same margin that you had before when rates were lower because of what you put it into, and without taking any risk in terms of duration and stuff. It's like literally exactly the same. When you were getting a 0 and making 3, and now you're getting a 2 and making 5 or whatever, it's the same. So I think that is not necessarily the problem. The problem is more if like large stuff. I don't know enough to know if like government thing, so some of them have local government, municipal stuff is a big issue. But I mean, very large clients, I think, would be a problem. Depositors, very large depositors. And there's some banks that are a little weird that way. So, I mean, there's like cross-border banks. So there's banks in the United States that have some of the biggest in terms of deposits per branch, that have large amounts of money that I think is tied to activities between Mexico and the United States and stuff. And so there's things like that. Yeah, and local in terms of being in the local area and everything, of course, yeah. I've always thought that money from other financial institutions is probably riskier, a risk that it will leave you faster. And I think from very large businesses and stuff is also risky because obviously you have a lot of the risk that will move to money markets and different things that we could talk about. But yeah. So, very small transaction things. Yeah. Bank of America is a good example of one that's very good in terms of deposit quality.
Can you save people a Google search or two and explain what time deposits are, or time money and demand deposits?
Yeah. So basically CDs versus checking accounts.
Yeah. So time, longer term, checking accounts, demand, you go and you can demand it now, today. So you're saying you typically like the deposit mix to be more households and individuals as opposed to hot money. What would you consider to be hot money? Would you consider other financial institutions to fall in that line?
Yes. Depends, but yes. If your primary reason for being there is like having higher rates or something, then yes, I would say that.
They shop it around.
Or yeah, exactly. And it's the same thing with loan things. Like people talk about loans and the economies of scale and banking and stuff, and that's true. But obviously, there's kind of more difficult product economics when you have huge loans, because if you're making a giant corporation that wants to, have a headquarters somewhere or something, let's talk about that for like real estate things. They're going to get, there's one rate that they're going to get. So like if they go with you and you're the bank that they've used for everything, that's fine, but they're going to pay the rate that they would have gotten from someone else. That's not as true for necessarily $200,000 instead of $200 million. It's definitely not true for $20,000. So if you think about your own life and everything, I think many of us have at least an account that there's very little risk that it will go no matter what. And even for people who aren't making a lot of money and whatever, that what that amount is, but there's probably $5,000 that isn't leaving the bank no matter what. But if you then say, okay, what about if it's $25,000? Well, if your average balance for a lot of households is 25 instead of 5, now you're starting to think a little bit about interest rates. At 5, you're not. It doesn't matter. Rates go from 0 to 10. You're probably still it's just considering that everything in your life is probably passing through that account and everything, that's not necessarily going to happen. But as you go to different ones, you think, well, I could move the 20,000 and put that in something else if it's pretty convenient. I'm probably not thinking I'll take that and put it into something that's locking up somewhere with some bank I don't know. But, there'll be credit card type companies that you heard of. There'll be PayPal type things. There'll be whatever. There'll be stuff that advertise online, and and if you can move it and do all these things, then you might do it. And as we get to really large amounts, you go 10 times up from that, then people are moving it when it's 200,000, right? And it's the same sort of thing for businesses, just on a bigger scale. So, even when we're talking about public companies and stuff, their first $1 million is not going anywhere, right? But that doesn't mean that 10 million is not going anywhere. Because if they start to think at all that, money is going to stay at those kinds of rates or stuff, then they need to work things out in a different way for that. But there are lots of banks where it could just shift to being a somewhat higher cost to them, but isn't going to leave the bank. So there's a lot of other options for it, right? Inside the bank, paying somewhat competitive rates, but not the highest possible rates. You might be able to keep a lot of the money and stuff. So I don't know nearly enough about it. this bank that way. And then obviously just like who the customers of the bank are is really important. We've talked about that before, but sometimes the customers that you're lending to are going to always want to be borrowers and not be a source of a lot of deposits. And sometimes on the other hand, which has happened to a bunch of banks, is that you often end up with households that want to deposit a bunch of money with you, but actually don't tend to generate enough loan demand to offset that for you. So you have to do something else. And, you know, I've mentioned that with Frost, where like they have a lot of household and stuff, but it's not for what they want to do. They're not going to generate a lot of loan demand from that. So the business is more mixed for them because they do more C&I, which is a little bit more, it tends to be a little bit more compared to real estate. Let's put it that way. If you're a real estate focused lender, it's going to be hard to get a lot of deposits because, you know, your clients are basically people who want to always be short money and long real estate. Right. You know, so it's not as even that way. And so they're going to be the ones that have more trouble, you know, unless they have different parts to the bank and all of that. So, you know, and then it depends on growth and stuff. So obviously the faster that they grew, the more likely that more of the money is, could be an issue of leaving. So, you know, we don't know. But that jumped out to me, that discussion of it. And I think that was not the most recent 10Q, but the one before that, actually. So I could be wrong, but I think it was 2 10Qs ago. So that particular one, which is the last bullet point here with Service First, is the thing that stood out to me about the bank. But yeah, it has an amazing record. It's not a very old bank. It has an amazing record through its existence, basically.
So just a pass for you.
For now, based on the deposit thing, yeah, because the deposit thing is the thing that's concerning me the most about banks right now. Yeah, there's lots of different things that could happen, but for the most part, looking at banks, I think it's not like they're being unrealistic about loan losses or something like that, but some are pretty calm about deposit things compared to what maybe they should be.
And this is just the first step in your investing framework of avoiding any potential catastrophic losses, right? And not saying that the bank's going to blow up, but if something is just a bit fishy, it's just easier to watch from the sidelines and see what happens. Avoid, pass.
And it'd be greatly alleviated if the interest rate situation was different. Yeah. So, but this is an issue for all banks in that we don't have much of a test historically for them. This is like a younger bank, grew a lot. For any bank that's younger, grew a lot or whatever, we don't have much of a test because we've gone through such a long period where people weren't seriously thinking about interest rates for a decade or something. So because of that, they have no idea what will happen with deposit. So it is like what banks went through in the late 60s to the early 80s, because from World War II on, they had, you know, there were interest rates that were higher than what we're used to.
Yeah.
But they then went to a whole different level. And so people's behavior changed a lot.
Got it. Next question. Assume you wanted to build a portfolio of 6 to 10 companies over time using the methods Geoff described in his If You Only Have 1 Hour a Day article, but are starting with 0 companies in the portfolio and a low 7-figure amount of principal, say from a recent inheritance or sale of a small business. What would you do with the large cash balance you would have over the first 2 to 3 years as you slowly identified companies to build out a 6 to 10 company portfolio? Kind of a common question.
Normally, I'd say you could put a bunch in an index fund or something. Right now, I'd say you could buy 2 years or less treasuries.
So keep it in cash.
I'd say for the average person with the amount they're talking about, you would just put it in a money market. Yeah, you can do. I would say just like a money market fund, as long as you make sure that you figure out that they're truly basically just in treasuries or reverse repo that's short term.
Why do you think you're more comfortable holding cash than other investors? Is it because you're a concentrated investor? So the moves are still meaningful even if you are holding a good amount of cash?
Well, yeah, that could be possible. I mean, so I have cash. The main reason I've had large cash balances before, which mainly happens if I eliminate one position or something, then suddenly I've had 20 or 30% of my portfolio in cash. So that's part of it. The other part is, well, one, I'd say my decisions have been very poor when making investments, mainly because I don't want to be in cash. So over time, the investments that are the most marginal ones of filling up that like fifth slot, let's say if it's a 20% in each one portfolio, or 10th if it's 10%, is quite a bit worse than the portfolio overall. Certainly, it has not performed better than the market. I would say it has not added to that kind of performance. Now, it has performed better than cash probably, but so that's one reason. The other reason is that I figure that I find something else eventually, and how much better the good things that I found are versus the less good is really, really big. So I would say that's another reason. I'm also just much more pessimistic on the overall level of stocks, I think, than most investors are. So like, I don't think it's unreasonable that when I say you might want to put it in cash, that cash will outperform stocks over the next several years. So U.S. stocks, at least.
Got a few more snap judgments. Overseas, international stocks. Let's see. McFarlane Group, PLC, 170 million pound market cap, packaging distributor. 20 years ago, the company sold off extraneous operations and focused on packaging distribution. Since then, they've rolled up a good portion of the UK and are starting to expand into the continent. Consistent 20% returns on incremental capital, with 70% of free cash flow reinvested and 30% dividend out, currently trading around 10 to 11 times free cash flow and essentially no net debt excluding leases. Over the last 10 years, stock price has CAGR'd at about 15%. Are you familiar with this company?
Yeah.
Of course.
I don't know. Yeah.
I was just going to say, pull it up on QuickFS.
Okay. I don't know enough about the business really, I guess. I've looked at it with the customers. So basically what they're doing is the customer is someone who's in between, something that's going to your UPS store or whatever, and someone who's buying everything and doing it all themselves, giant company, which is most of the companies that you can think of, publicly traded companies and stuff, would kind of fall into this category of wanting to sort of outsource this in a sense. So while they said it's a distributor, it's more like they're taking on that for you, that there's a middleman that's doing this instead of you doing all this stuff yourself. So there's a few things. I think they talked about the free cash flow, but the free cash flow has not been super high, right?
That's been pretty high.
Yeah. And then the price is fairly normal, right? Let's see. How's it done since COVID and stuff in terms of, let's see.
You want to go key ratios, price? Like valuation? You want to see a stock chart?
You can, that whatever you got there, that's fine. I was just curious about what's happened. The overview is fine.
Okay.
What's happened since COVID. Yeah. It looks interesting.
Is this the type of business you would be interested in?
At the right price, maybe.
EV to sales,
yeah,
0.6, 10-year median margins on EBIT, 5%. It's kind of right in the wheelhouse, right?
Yeah.
Would you demand a better price because it is a international stock? This isn't like you're investing in Domino's Pizza of the UK, right?
Yeah, there's a few issues here. So they're not issues that it's a bad stock or something. They're just issues in terms of why it might not be the first thing I think of, right? So what's the 10-year median gross profit?
31.3%.
Okay. So it's not particularly high that way, right? That doesn't mean that that's bad, but the returns on invested capital are what they are and all of that. The issues really has to do with, like we said, the customers and understanding this. So it is in a portion that's a little harder for me to understand. It doesn't mean that I can't research it and figure it out. But it's hard to say because the UK market is a bit cheaper than the US market in some ways, but it's probably a bit attractive. It's not super high quality business and it's not super cheap, but compared to what we're seeing today in terms of your options for the price and everything, it's good. Yeah. If you had a widely diversified portfolio, this would be something that I think would make sense as part of that. Or if you were UK based and understood these things better or whatever. yeah, I mean, it doesn't get me super excited about things, but I don't have a problem with either the price or the returns.
Very good. And then he asked for another one. S&U PLC, £250 million market cap, UK auto lender, has multi-decade history of 15 to 20% returns on equity. He went through the financial crisis, currently trading at a PE of 7 or 8 and a price to book of 1.2, well below historical averages. Stock has been essentially flat for the last 5 years due to substantial PE and price to book multiple compression.
So this company's similar to CarMart. I mean, that's the closest that people could think
So
of.
remind me of, yeah.
Like what the charge-offs are and what segment of the industry they're serving. So like delinquencies and stuff are probably high or about to get high in that if it's similar to the U.S. where that's happening now. I mean, for me personally, I'd probably buy CarMart because I just have more of a familiarity with that. I can go see where it is, where it's located, those things, and get some comfort with that. But yeah, it's probably not a good time for them, like what's about to happen. But it's an attractive stock in terms of its returns over time and its attractive price. So, but I understand why people avoid it because people avoid this stock. They avoid CarMart because it's pretty scary for them. So, this business also has a little bit that is different from that. They do a little bit, I think it's like bridge financing they talked about or something. So they have a business that's a little, that is not the same. But I don't remember how
property bridging.
What do they say there? Mm-hmm. Okay, yeah. So that's obviously unrelated to the like subprime car.
Got it. And then let's see. A quick question for Mr. Gannon. You mentioned that you regret reading too many books about theoretical value investing in the mid 2000s. Which books specifically are we talking about? And which ideas do you wish that you hadn't internalized from those books? Questions on gross profit. What's the highest acceptable price of gross profit and why?
Well, I'm not going to say what books they are because people worked hard on writing those things. And
you're a gentleman.
I would say the value, quantitative value type stuff, probably more so. Yeah. So sort of, how do I put this? What people call a lot of times Ben Graham stuff, but if you really read Ben Graham, I don't feel that falls into that category. I think Ben Graham and the book A Man for All Markets and all that stuff is sort of a different category in terms of it's not just saying things that are very cheap or something, but things that you could prove in a sense are cheap in sort of a logical approach using things like net current assets and stuff I think is different. But yeah, I think a lack of focus on common sense and business analysis and more on what things work statistically, quantitatively, factor things, whatever, that kind of stuff. And then questions on gross profit. The highest acceptable price to gross profit. I mean, I guess it's a little hard. Well, I don't know if there is a particular answer to that because it would depend on the sort of like G&A level stuff, right? Mm-hmm. So, Amazon or Costco or something could have higher prices to gross profit maybe than the Container Store or something, just because the way that the business is set up, that they're probably such high, there's not such giant scale, right? So something of tremendous scale could be cheaper that way. I mean, I don't know the answer to that just because of how fast it would be growing and all of that. Mm-hmm. But yeah, I would be.
Maybe he's asking because the last podcast we did when we talked about Shopify at like 70 or 80 times price to gross profit. Yeah.
I mean, there's some expensive stocks out there right now in terms of gross profit and sales. Yeah, I don't, it probably isn't a good idea to pay 30 times gross profit,
Yeah.
Let's start with that. I don't think it's usually a great idea to pay 30 times earnings, and gross profit is not earnings. So, yeah. But if it's growing extremely rapidly and stuff, it would just be hard to calculate that, right? Mm-hmm. And then gross profit to tangible assets. I would say you want to be over 50%. What's good? Some are tremendously high, but I think in general you want to be skeptical of businesses that generate less than 50% gross profits versus tangible assets. Though there could be exceptions to that if they have like big scale and whatever, and you could try to figure it out. But for your average business, I would probably set it at around 50% if you want to kind of say, what's the dividing line between maybe a better than average business and not so good business. I wouldn't worry about insufficient gross profits to tangible assets unless it's below 50%. So
some evidence
so
of
if
a good business.
Yeah. So if it says gross profits of, 10 million or whatever, then I wouldn't want to see tangible assets of more than 20.
So 13Fs came out, 13F, and was looking at Berkshires.
Yeah.
And
so
there's a few things. I mean,
there was one interesting one I noticed.
Well,
okay, what did you notice?
I mean, the Taiwan Semiconductor.
Yes.
Selling that.
Yep.
So I wanted to get your opinion on that.
Right.
Yeah. Sold that
or
out.
Virtually completely.
I mean, he built the position, what was it, like in Q3 and then sold it in Q4, which if Buffett's doing that,
that's interesting.
That tells you, obviously, he thinks he made a mistake. We have it right here, Q3 2020 or 2022, Q3. Yep, he bought 60 million shares. And then when they had to report, they were down to 8 million shares. He still made money, even though, pennies or whatever, or dollars, but still something clearly scared him off, which, that was Buffett.
Yeah. And I don't know if we know exactly, because that's using like when they say reported price, right, on this website, they mean Dataroma. They mean like the price it was at the time of the filing.
Oh, okay.
Is that what they mean?
I'm not sure.
I think so, because they're drawing from different things. But if they're drawing from like the 13F, then they're using what price it was at the end of that quarter, as opposed to if they have like Form 4 or whatever, things like that. But that's a good. I mean, obviously, you reconsidered, right? You probably weren't buying a stock just to make money on it for a quarter. So, yeah, I don't know. I thought it was a Buffett investment, and I'm not sure if it would be either of the other two would go in with the intention of holding for like a quarter.
Do you have any thoughts on that in general? I mean, that was shocking to see.
Yeah, I mean, I thought it was interesting. I wouldn't have been surprised if it kept growing in size once that investment was made. It's not one that I would buy, and it's kind of outside of circle of competence for Buffett generally, but we speculated, well, maybe, Apple, learning about Apple and stuff and all of that might have been that there would be something like Taiwan Semiconductor. And Taiwan Semiconductor, of all the semiconductor companies, makes the most sense because of exactly what it does, its place in the industry. It's way closer to a Buffett type thing than, he's not going to buy any of the other ones that I could think of, So although it's called semiconductor, it's a completely different business, right? And we talked about how that might be with the economies of scale and everything, that's something he'd be interested in. But whoever it was, they sold.
And bank stocks were sold as well, which somebody had emailed in about. So you could see USB, Bancorp, Bank of New York, Mellon, and is that the only one? Yeah, and then he also added to, I'm assuming it was him, added to Apple as well. But it could have been, one of the younger guys, as they refer to them as.
And a little sale of the arbitrage position, but not a huge one. Yeah.
But somebody had wrote in and said, are they relatively less attractive? Why has Buffett been selling almost all his bank stocks? He said that would be weird given the low valuation relative to the market. Does he see particular risks in the industry? That seems to be the only explanation, but you might have other thoughts. So do you have any thoughts on why Buffett has been selling down some of his financial stocks?
Well, he hasn't been selling Bank of America. So this is a thing that we've seen for a while, that he focused on Bank of America and hasn't sold, and has sold off the other things. And so that's kind of a continuing thing that we saw back when it was Wells Fargo, and he had sold some other ones down over time. So I don't know what to make of that. He didn't sell Citigroup, right? Is that right?
Yep, correct.
We don't know that's him, by the way. That could be definitely outside of his the size of the stocks. That would definitely be him. But Citigroup's pretty cheap and stuff, so he's probably by far most comfortable with Bank of America. The other banks that he was selling, no, I don't know that there's much in the way of big risks for them. A couple of them are very different. The rate thing does have some I mean, it's a little different for Bank of New York than for a lot of other banks. They have big businesses and stuff that other banks do not, but I don't know that that's a reason for selling any of that. U.S. Bancorp has been a very long-term holding, right, by Berkshire.
Mm-hmm.
I think they may have bought some more, like around the financial crisis or something, but it's a long-term holding. But one that I believe has been shrinking over time. And they got completely out of JP Morgan, right, even earlier. Yeah, so definitely just focusing on Bank of America. But Bank of America is a huge position for them.
Yeah.
So I don't know. I mean, I don't think, is he actually underweight banks compared to other people now? I mean, what's the index made up of banks and stuff, you know, like, I don't know. It doesn't, I'm not sure. Look, I've always thought the banks were most likely to be Buffett positions, and Buffett does eliminate positions that get too small and stuff a lot of times, unless he really likes the people involved or something. If it was like M&T or something, and the person that he had invested with was still there or something, then he probably would keep it. But, you know, otherwise he tends to focus on just owning the biggest that he likes in that industry, you know?
Yes, maybe that's it. He just wants to just own Bank of America. Apple, 38.9% of his portfolio. Huge position. And it's funny because then you look at the other stocks in the portfolio and they're just, I mean, the Bank of America is the next biggest one at 11%.
And he hasn't trimmed at all American Express. So now one thing about Bank of America and American Express, they are not very exposed to risks in terms of borrowing short and lending long. Right. So like American Express, if you look at QuickFS or something, we could, they are very different. So they have a bank now because of the financial crisis and everything. So, you know, and then people know them as the credit card company. Yeah. And unlike other credit card companies, they are underwriting the loans as well as running the network. So what you see there with the spread and everything is that's why their loan loss reserves will be their loan loss provisions are high, is because they're a credit card company, right? But they aren't making long-term loans, and they would benefit from like float and stuff like that. And then we talked about Bank of America's great deposit base and stuff too that way. So these are two that would be probably of the giant financial companies. I would think, I haven't looked at them closely recently, but I've got to think that they're two of the least exposed to the risks of what we talk about, like inverted yield curves and all that kind of stuff, of the risks of deposits flowing out, like we talked about, and also of like paying a lot for short-term money and then not being able to charge a lot on the longer-term side, right? Definitely not a problem for American Express.
I mean, he's held Bank of America for a pretty long time, right?
Yep. And and he's held American Express for an incredibly long time. I mean, of the financial things, that's the one he's most. Geico's the most, you know, which they own completely. But the second most connected to Buffett historically is American Express. You know, bought it in the partnership years, bought it again in the 90s, and you know, owns it through to today. Yeah. So I don't know all the, like, I'd have to look carefully about how they've done and how they were likely to do in the future. But if it was an issue about bank things that way, it could just be him trimming things to get rid of it. The other possibility is that these are a little bit different in that I think that they're the kind of banks that he likes the best, and they're the least exposed to having trouble between borrowing short and lending long, you know.
Which is something you've been
He's
worried
talked
about.
a lot about that.
I mean, you were talking about that early in the podcast, but we've spoken about that really since like beginning of 2022.
I mean, we've been talking about it since 2021, doing things about it since maybe 2022 or something. But yeah, but being concerned about it and stuff. Yeah. Because the reaction speed, whatever you want to call it, the way in which banks have reacted and others have reacted and analysts and everything has not been too fast. They're not overreacting to the risk, I would say. So I think people have been pretty relaxed about it. So whereas like with the loan losses and stuff, which I hear more talk about that sometimes, the delinquencies like we talk about subprime delinquencies and stuff, but that's built into the business of something they worry about all the time and they talk about it. So, you know, it'll be unpleasant for them for a period of time for these companies, but they're used to that. These, this is something that anyone who works at these banks hasn't really experienced before. So, I mean, we're talking something that hasn't happened for like 40 years. So, at this speed and this experience of it and stuff. So, yeah. And Buffett might have some concerns that way, but I don't know, because if he had really big concerns, he might sell even faster than he has and stuff. So I think my guess would be that he really loves Bank of America and American Express in a way he does not love the other banks.
And he has permission to purchase more Bank of America too, right?
Mm-hmm. Yeah.
That's not something that he would dart in and then dart out pretty quickly.
No. No, it's a very big position. And the American Express one is a very long-term position, that he's had forever. So, yeah. So, but I mean, if you add those up and then consider that Berkshire is itself in finance-related things, actually in terms of holding stuff outright that people may not realize in terms of their, the manufactured housing stuff and things like that are mainly to hold mortgages, basically. And then insurance, this is a heavily, heavily financially oriented company. So, it has a portfolio that probably I don't think is underweight financials compared to the index, but I don't know.
Cool. Well, I'll thank everybody so much for tuning in with Geoff and I on the Focus Compounding Podcast. 5 years in, having a lot of fun doing it. We will see you 5 years down the road. If you've been with us since the beginning, which I know some of you have been, thank you so much for tuning in with us every single week. We constantly iterate and try to make the podcast the absolute best that it can be. And we're always open to feedback. And a lot of the changes we have made over time have come from feedback. Thank you so much to everybody for tuning in with the both of us. My name is Andrew Kuhn. His name is Geoff Gannon. We are part of Focus Compounding. And we will see you in the next podcast next week, per usual. Take care.